Hey everyone, welcome to our deep dive today. We're going to be looking at something super interesting, global capital flow cycles.
Yeah, those sound pretty drive.
Well, yeah, maybe on the surface, but we're going to show you how these cycles actually have a huge impact on the world and how recognizing these patterns can help us understand what's going on in the global economy.
Right, it's not just about numbers, it's about real-world events.
Exactly. So to get started, we're going to be diving into this research paper from back in 2017.
Yeah, by Carmen Reinhart, Vincent Reinhart, and Christoph Tabesh. It's called Capital Flow Cycles, a long global view, and it was presented at the IMF.
Okay, so right off the bat, this title kind of gives you a hint that these researchers were thinking big picture, right?
Oh yeah, for sure. They wanted to look beyond the day-to-day ups and downs of the market and see if there were any larger long-term patterns in global finance.
And spoiler alert, they found some pretty amazing stuff.
Yeah, they did. They actually built this incredible database going all the way back to 1815.
Wow, that's over 200 years of data.
Exactly, and when they crumped the numbers, they identified 14 distinct cycles, these capital flow cycles.
So it's not just random chaos, there's actually a rhythm to global finance.
It's almost like waves, these waves of capital washing over the global economy.
Okay, so we've got these global financial cycles, but what does that actually mean for the average person? Like, what are the real world effects of these cycles?
Well, that's where things get really interesting. These cycles are linked to things like commodity prices. So think oil, gold, things like that.
Okay, so it's not just money moving around, it's affecting the prices of things we use every day.
Right, and the researchers actually found 22 distinct commodity price cycles happening more frequently, but with less extreme booms and busts compared to the financial cycles.
So we've got financial cycles, commodity price cycles all intertwined. Kind of makes you wonder what else is connected with this global economic dance.
Well, you know what they found? This really interesting link between low interest rates at major financial centers like the US or the UK and those booms we were talking about.
So cheap money leads to more investment, which drives up commodity prices.
It often happens all at the same time, yeah.
Sounds like a pretty good deal, right? I mean, who doesn't love a good economic boom?
Yeah, but here's the catch. These booms often lead to busts, and these busts can be pretty painful. They call them triple busts.
Okay, triple bust, that sounds ominous. What exactly are we talking about here?
Well, picture this: capital flows suddenly dry up, commodity prices plummet, and then you see a spike in sovereign defaults.
Wait, sovereign default, so countries start defaulting on their debts?
Exactly. It's kind of like a domino effect.
Yikes, and this isn't just theoretical, is it? This actually happens in the real world?
Oh, yeah, absolutely. All six major spikes in new defaults between 1800 and 2016 happened right after a global capital inflow bonanza ended.
That's a scary thought. So if we know this is a pattern, if we can see it coming, does that mean we can do anything to avoid it?
Well, that's the million-dollar question, isn't it? One key factor they found that influences this whole system is how easily capital moves across borders. They call it capital mobility.
So if money can flow in and out of countries really easily, that makes the system more sensitive, right?
Exactly. And a great example of this is from way back in the early 1800s in the UK. They had all this high-interest government debt, and they decided to convert a bunch of it to lower interest rates.
Okay, sounds like a smart move. Lower interest rates, less money to pay back, right?
Well, yeah, in theory, but what happened was they basically pushed investors to look elsewhere for better returns.
So it backfired.
It's like squeezing a balloon. The capital had to go somewhere, so it flowed out of the UK and into other countries that offered higher returns, places like Latin America.
So even a seemingly domestic policy decision can have these huge global consequences.
Yeah, it shows how interconnected the global financial system really is.
Okay, so we've got all these pieces of the puzzle, these global financial cycles, commodity prices, interest rates, capital mobility, but who's actually calling the shots? Is there like one big puppet master controlling it all?
Actually, no, that's another really important takeaway from this research. It's not about one single player. It's more like a global dance with lots of different partners.
Yeah, it's like a massive party. Everyone's moving and grooving to their own beat.
Exactly. And the researchers actually found that about half the variation in these capital flows is explained by just two main factors.
Okay, so it's like a super complicated dance routine, but there are some key moves that everyone seems to be doing.
Yeah, and trying to figure out those key moves is what makes this so fascinating, and it helps us understand why certain things happen in the global economy.
Okay, but this is all historical, right? Does any of this actually matter today?
Oh, yeah, absolutely. In fact, there's something really strange happening right now that doesn't quite fit the historical pattern.
Oh, that doesn't sound good. What's going on?
Well, since 2011, we've seen a double bust with both capital flows and commodity prices taking a hit.
So based on what we've talked about so far, we should be seeing tons of countries defaulting on their debts, right?
You would think so, but that hasn't really happened.
Wait, so where are all the defaults? That's weird.
Yeah, and that's the million-dollar question. Why are those defaults missing? And that's what we'll dive into next time.
Okay, so we left off with this mystery of the missing defaults. I mean, historically, a double bust like we've seen since 2011 should have caused a wave of countries unable to pay their debts, But that hasn't really happened.
It's a real head-scratcher, and there are a few ideas floating around about why this might be.
Okay, well, let's hear them. What are some of the leading theories?
One thought is that those historically low interest rates we've seen in recent years, they've kind of given countries some breathing room, you
So
know?
it's cheaper for them to manage their debt when interest rates are low, making it easier to keep up with payments.
Exactly, like a financial cushion to absorb the impact of those economic shocks.
Okay, so low interest rates could be buying some countries time to get their finances in order, but then there's the whole China factor, right?
Right, China's become this major lender on the global stage, and their approach is quite different from traditional lenders like the IMF or the World Bank.
Yeah, we touched on that earlier. How does China's lending style differ?
Well, they tend to attach fewer conditions to their loans.
So countries in trouble might turn to China because it's easier to get those loans without having to make tough economic reforms.
Yeah, it's possible that some countries are avoiding default by turning to China for help. It's definitely a wild card in this whole equation.
It adds another layer of complexity to an already complex situation, that's for sure. But speaking of complexity, we talked earlier about how policy decisions in major financial centers can trigger these global capital flows.
Oh, yeah, those financial centers have a huge influence on the global economy.
So can we dive into some specific historical examples that really illustrate this connection?
Absolutely. History is a great teacher, and there are tons of fascinating cases that show just how powerful those global cycles can be. Take the Latin American debt crisis of the 1980s.
Okay, the 80s, big hair, big spending, and a big debt crisis. How did those global cycles play into that?
Well, during the 70s, a lot of capital flowed into Latin America, partly fueled by low interest rates in the U.S. Investors were chasing higher returns, and Latin American countries were eager to borrow. It was like a party, and everyone was invited.
It sounds like a win-win situation at first, but then what happened?
Well, in the early 80s, U.S. interest rates suddenly shot up, and that made it way more expensive for those Latin American countries to service their debts, you know?
Ouch, so the party's over.
Pretty much. And on top of that, you had declining commodity prices and some other economic turmoil brewing. It was a recipe for disaster.
And that's exactly what happened, right? A wave of defaults across Latin America, a classic example of a triple bust in action.
It really highlights how these cycles aren't just theoretical. They can have huge real-world consequences for entire countries.
So understanding the role of those financial centers is crucial for anyone trying to make sense of the global economy, right?
Oh, absolutely. They're like the central nervous system of the global financial body, sending signals that can trigger massive capital flows.
You mentioned earlier that the impact of those decisions is amplified when capital mobility is high, but doesn't that also make the system more vulnerable?
It's a trade-off for sure. High capital mobility allows for faster economic growth and more investment opportunities, but it also makes the system more prone to shocks and crises.
So it's like a high-performance engine capable of incredible speed, but also more likely to overheat if you're not careful.
A perfect analogy, understanding how those financial centers operate and how their decisions interact with global capital flows is essential if you want to grasp the complexities of the global economy.
Okay, so we've covered a lot of ground here. Interest rates, commodity prices, the role of China, those powerful financial centers. But what else can we learn from this research that might help us anticipate what's coming next in this global financial dance? It really feels like we're getting a glimpse behind the curtain with all this, seeing the gears turning in the global financial system.
Yeah, it's all about understanding the forces that drive these cycles and how those forces interact.
So based on everything we've learned, what are the big things we should be watching for? Like, what are the red flags that might signal trouble ahead?
Well, one of the biggest things to keep an eye on is interest rates.
Okay, interest rates, we've talked about those a lot. Why are they so crucial?
Well, because they're a major driver of these global capital flows, and even small changes in interest rates can have a ripple effect across the world.
Okay, I'm following with you. So what should we be looking for specifically? Like, what would be a warning sign?
Well, if interest rates start to rise significantly in major financial centers like the US or Europe, that could be a signal that things are about to shift.
And why is that? Because higher interest rates mean borrowing becomes more expensive.
Exactly, and that makes it harder for everyone to manage their debt, especially countries that are already carrying a lot of debt.
So it could push some countries closer to default.
It's definitely a risk, and if those higher interest rates in the financial centers start attracting capital away from emerging markets, well, that could make things even worse.
Okay, I see. So it's like a double whammy, higher borrowing cost and less investment coming in.
Right, and that's why it's so important to pay attention to those interest rate trends. They can tell us a lot about the direction the global economy might be heading.
Okay, so interest rates are definitely on the watch list. What else should we be keeping an eye on?
Commodity prices, remember those triple bonanzas and triple busts we talked about?
Oh yeah, those were scary.
Well, if commodity prices were to take a sudden plunge, that could really shake things up, especially for countries that depend heavily on exporting those commodities.
Because their income would take a hit, making it harder to service their debts.
Exactly. It's all interconnected, and that's why understanding these global cycles is so crucial. It's about seeing the bigger picture and recognizing how seemingly isolated events can actually be part of a much larger pattern.
It's like having a roadmap of the financial landscape so you know what to expect and how to navigate the terrain.
Exactly. You can't predict the future, of course, but understanding the past can definitely give you an edge.
Okay, so we've got interest rates, commodity prices on our radar. Any other key takeaways we should keep in mind as we look ahead?
Well, don't forget about China. Their emergence as a major player in global finance has added a whole new layer of complexity.
Yeah, that's right. Their lending practices and the sheer scale of their investments are having a huge impact.
Exactly how China manages its own economy and its role as a lender will have ripple effects across the world. It's a dynamic situation that's definitely worth watching closely.
Okay, so it's a lot to keep track of, but I feel like we've gained some really valuable insights from this research and your expertise.
Well, that's the goal, right? To shed some light on these complex issues and help people understand how the global economy really works.
Absolutely. So for our listeners out there, what's the one big takeaway we want them to remember help about global capital flow cycles?
That the global financial system is interconnected, maybe now more than ever before. Decisions made in one corner of the world can have profound consequences on the other. So stay informed, stay curious, and always keep those historical patterns in mind. They can offer valuable clues as we navigate this ever-changing world.
Well said. I think that's a great note to end on. So that wraps up our deep dive into global capital flow cycles. We hope you found it informative and maybe even a little bit mind-blowing. Until next time, remember, knowledge is power.